Good evening, good afternoon. Welcome to the webinar for Avalon of Hermitage in Nashville, Tennessee. My name is Ray Hightower. We are joined by Scott Holmes. We'll drill down and tell you a little bit about us as we get into the presentation. But the first thing I want to do is make sure that you're aware of our disclaimer. You'll get a copy of this deck so that you can read this yourself or take a screenshot of it. But the bottom line is this is all of the legalese that our lawyers insist that we share with you before we talk about this investment opportunity. This is Avalon of Hermitage, and this is a quick shot of the property. 145 units, built in 1996, a very attractive asset that has not been cared for very well. Our team has strong asset management skills, and the previous owners, not so much. We saw a lot there when we were doing our walkthrough, and Scott will tell you a little bit about this as we get into the presentation. Here's how we're going to start off. We believe that if a person knows a subject really well, they can explain it in simple terms, and then we can drill down into it as necessary. So what we're going to do is we're going to explain this deal in CEO level terms, assuming that someone is a CEO of another company, not a real estate company, but CEO of a tech company, or CEO of a media company, or some other sort of company. We're going to explain this on a CEO level first, and then we'll drill down into details, real estate details. And if you have any questions about what we're going through here, we'll be sure to answer them for you. Pop them in the Q&A, and we'll make sure that we answer those questions for you. So to start off, key things that we're going to cover, we're going to talk about the property, location, numbers, performance, projections. We'll talk about the team. Scott and I are CEOs of our respective teams, and that's who you have on the call right here. We're going to answer why you should trust us and have we done this before, because you want to know that from the people who will be managing the asset for you as you are the investors, and we're here to manage the asset for you. We'll go through our business plan. What are we doing with your money? How will we keep your money safe? How will we make your money grow? So answering those questions on a very high CEO level, this is a 145 unit property in Nashville, Tennessee. We're paying $32.2 million for it, and we're going to put roughly $2.85 million worth of CapEx into the property. There's some improvements that need to be made here. On the team, CRE Capital and Bridgetown Partners. You have the leaders of the two teams here. Scott Holmes is CEO of CRE Capital. One of the reasons I really enjoy working with Scott is because he has over 25 years of experience in the commercial real estate industry. He's been on the brokerage side, on the asset management side, on the development side, and he's worked in multiple asset classes as well. He knows multifamily very well, and because he has worked in other asset classes, he can take his knowledge from those other asset classes and apply that to what we're doing here at Avalon. So it's really an honor to be working with Scott and his team at CRE Capital. My name is Ray Hightower. I lead Bridgetown Partners. My background is in technology. Many of you on the call know that I started and ran a technology company for 21 years before selling it. And after selling that company, I entered the multifamily business. So I'm acquiring multifamily properties here in Arizona. So far, I'm over 420 doors here in Arizona and acquiring in Tennessee, because many of the advantages I see in Arizona, I also see in Tennessee. Job growth, income growth, population growth, and we'll talk about those in detail in the presentation. Our business plan, we're going to buy the asset because it's in the path of job growth. We're going to make improvements, increase revenue. That is, we're going to do things to the property that justify the increased rents that we'll be charging. We'll pay distributions to the investors. That's you. You'll get your return on investment, and we'll share the tax benefits with our investors as well. Our plan calls for a sale after 5 to 10 years. If you're interested in the investment, and I'm sure that you will be, all you need to do is go to bridgetownpartners.com, sign into the investor portal where you can read and sign the documents, wire your investment, and collect your profits. And we can go through that again towards the end, but that's our brief overview. I'm going to turn this over to Scott, CEO of CRE Capital, who will go into details on Avalon.
Very good. Thanks, Ray. One thing you forgot to mention is we're both Eagle Scouts. That was another
Yes.
rapport that we had when we first got to know each other.
Yes.
Yeah, so as Ray mentioned, Nashville, a lot of things that we'll get into in this presentation are why Nashville, right? We'll hit that up front. But just on a personal level, I've purchased more units in Nashville than just about any other market in my career. I would say maybe in Nashville and Atlanta are probably tied uh, several thousand units in my career on more of an institutional side. So more of a core, pension fund advisor, institutional role that I've had in acquisitions in my past. So love Nashville. We've been trying to get a deal in Nashville for quite a while. Been bridesmaids a few times on some deals the last year, and we stuck to our knitting, kept our conservative standards and all of that, and finally have gotten a really great deal that we like a lot. So most people know, especially if you're on a webinar like this, what the benefits of multifamily investing are, but there's just a little snapshot of things that we like. One thing that's not on this slide that maybe we'll update for the next time is the inflation hedge aspect of investing in multifamily and in commercial real estate in general. With all the inflation talk right now in the marketplace, one reason why institutions invest in commercial real estate directly and in multifamily specifically is because it's a very inflation resistant asset class. More so than any of the other commercial asset classes, I would say too. If you have an office building or a retail center or an industrial park, those are big, company long-term leases that have fixed rates that stay relatively flat for a long period of time. But when you're in an inflationary environment and you have 145 units that roll on a pretty even schedule all throughout the year, that allows you to adjust your income and to take advantage of rising rents, which is certainly part of our business plan, in addition to forcing appreciation through improvements like a capital improvement project like we have for this asset. So in addition to those things that you see on this slide, that's another reason why we like multifamily right now. So why Nashville? You always have to answer the high level question first. As I mentioned, I've done a lot of units in Nashville, other product types as well in Nashville, retail and industrial particularly. Um, and for goodness, probably 20 years now. I think the first time I bought a project in Nashville, it was about 2001, 2002, somewhere in there. So it's been over 20 years that I've been doing multifamily specifically in the Nashville market, and before that for industrial and other property types. But you can see it's just all the things that were going well and why people wanted to go to Nashville before have only gotten better since the pandemic. People like the culture, they like the weather, companies like the business friendly environment. You can see there on the bottom right, Oracle announced a new campus that's going to bring some good high paying tech related jobs. They're spending $1.2 billion to do that. And then, I won't call your attention to everything here, but you can see that, average household income is strong, job growth. I mean, the number one thing you should care about as a multifamily investor is job growth. Job growth, income growth, population growth, those are kind of the three biggies that you should look for in any market when you're evaluating them. And then one other thing I'd say on that slide before we jump off, if you don't mind going back,
Yeah, sure.
is the rankings. The Wall Street Journal did a study um, where they ranked, and this was last year, 2021, where they looked at 5 different characteristics, to rank 300 different metro areas around the country. And Nashville came out number 2 in that ranking, weighting all those things together. So a lot of people know Nashville is a good market, and it's been a competitive market because of that. So, like I said, we've gone after several assets here, and we're glad we finally got one. Moving on to the next slide, this is kind of a overview of just the multifamily market. The top right is a chart from Marcus and Millichap Research. And you can see, the 1 year where there was a slight dip in rent growth, no surprise, was 2020. And that was just barely below zero. A lot of other markets got hit a lot harder than that. But as you can see in 2021, rent growth came roaring back to 20% across the Nashville markets in multifamily. And now it's kind of pared back to still a little bit above the average where it was in the years leading up to 2020. It was in that high single digits range. So, and it's because of that second chart at the bottom. Population growth has continued in Nashville, particularly among young people, young adults. That's really your prime multifamily renter market is that young adult population. And so we've seen a lot of that movement into the Nashville market, and we expect to continue seeing that. Nashville, Tennessee, I should say, the state is one of only 7 states that doesn't have a state income tax, and yet their state budget is in a surplus. So maybe some other states could take a lesson from that and see how they're doing that exactly. Investment highlights on this deal. This is on a 5-year projected hold period, a little bit over a 2 multiple for those who track the multiple. It's a 206, I think, in our base case. Average cash on cash to the passive investors. All these numbers that we're presenting here are the passive investors, not the other partners. So this is what you would be looking at, and we'll have another slide that shows you what is projected for an average, $100,000 investor, just as an example. But 8 to 10 cash on cash, IRR in that 16 to 19 range. And then the last one, average annual return, that's just basically the total return divided by 5 years equals, between 20 and 22% annual average annual return. So very good, strong returns. And as you'll see, on a very conservative set of underwriting. This does not include several items that may actually allow us to outperform this, which we'll talk about as we get into the business plan a little bit further. Sources and uses. This is, as Ray mentioned at the beginning, we are under contract for $32.2 million with the seller. One thing we always do is we add a minimum of 6 months of operating expenses from our year 1 budget to the operational capital, just to give us some buffer, especially in an environment like this one. But this is just something we always do. So that's what that $600,000 and change is on the second line. The capital improvements is actually a little bit higher than that. 2.85. So maybe this is a one we'll update, Ray. That one did just get the change in there. But capital improvements, that's basically the interior renovations plus the exterior renovations. So none of the interior units have been renovated yet. That's why we like this deal as well. It's about 25 years old, usually in that 20 to 25-year-old range is the first time that you're going to really do a big value add, upgrade. And as Ray mentioned, the current ownership really hasn't done much of any of that. So there's an opportunity for us to do a lot of exciting things. And then the closing costs. And then on the bottom, the debt financing. One thing that has kind of kept us out of several deals over the last 9 months or so is the fact that bridge debt was so popular and people were using these low rate, floating rate bridge debt deals, and that has made us nervous. That's just not our style, I guess you could say, as investors. We want to be more conservative, and so this debt is agency fixed rate long-term financing. In this case, Freddie Mac. So we've got 5-year interest only. It's fixed rate. In fact, we just submitted the package today, earlier today. So but it's also lower loan to value. So where a lot of other syndicators that you might see presentations are showing, 70, 75, 80% loan to value, this is barely 60% loan to value on the purchase price. And again, we'd rather do that in an environment like this just to stay more conservative. And we especially didn't want to touch the floating rate environment since so those short-term rates are what drive those floating rates. And that's gone up considerably as the Fed has been raising rates, as I'm sure most people here are aware. Compared to longer term deals, that's driven by the long-term treasury market, which has been more stable than obviously the short-term Fed-driven rate increases. That's all I'll say on this one. We'll talk about that a little bit more as we get in. As I mentioned, conservative financing. I won't repeat myself on that. I already talked about that. Our underwriting is also conservative. Generally, the rule of thumb for an exit cap is you want at least 10 basis points a year per year for the uncertainty of where the cap rates are going to go. Given the current environment, we've upped that to 20 basis points a year. So our exit cap is 100 basis points or a full percent higher than our going in cap. And again, that's just a conservative way to underwrite that makes us feel like we can definitely perform. Our motto, and I'm sure Ray's is as well, is we want to underpromise and overdeliver. So the numbers that you're seeing here are conservative and very achievable. So here's what a projected $100,000 investment would look like. The percentage returns above, but really what you care about is the cumulative cash flow return. So year 1, we expect to be in that 5 to 6% range. Again, because we'll just be taking it over and starting the value add and the renovations and all of that. It'll take us through year 2 to get through all those units. And then finally by, years 3 through 5, we'll be at a new stabilized higher rent, fully renovated project at that point. One thing that is not in here that a lot of others will project as well is some kind of refinance, or in the case of agency debt, Freddie and Fannie, one of the things we really like about that as well is you don't have to fully pay off your existing loan and do a refinance if you want to take advantage of the value increase that you've created. You can do what's called a supplemental, which is essentially, keeping your existing financing in place so you don't have to pay any prepayment penalties or anything like that. And then you're just getting a new appraisal of the new higher value, and then they'll loan you, in our case, 60 to 65% loan to value. They'll loan you the difference basically over your existing loan and where they value the property. And so we could get as much as, $10 million of additional loan proceeds out of a refinance situation like that, maybe even more. But that's not in these numbers. And what that would allow us to do is return part of the initial capital back to the investors. So you may be able to see, in year 3, 4, some of your capital back. But again, that would only increase the return levels that we're projecting here. And so we just wanted for the base case scenario to show none of that. This is just the purchase loan only that's in this. So if that happens, obviously people are always happy about getting some of their initial capital back. You'll continue to still own your piece of the deal, obviously, and get your cash flow returns and all of that based on that. Sometimes people ask that question. If I get some of my capital back, does that mean I don't get paid? No, you do. You still get your share of the profits at that point. So we'll talk about that.
Scott, I've got to say, this is one of my favorite charts of the deck for the reasons that you mentioned. One, like in year 1, the returns are lower than what we see in subsequent years because all of the units, or so many of the units, are vacant because we're doing the CapEx that we're doing. But we see how those ramp up in later years. And that does not include the supplemental financing that you mentioned. So I like this chart.
Yeah, so if you can hit your numbers without having to do that,
yes.
That really shows how strong a deal it is.
Powerful.
All right. Timeline, first 2 years really is where we're going to do most of the heavy lifting. We're going to talk about bullet point number 2 here in just a minute when I show you the floor plans. One thing we discovered when we were there, and actually I should have said this at the beginning, the unit mix, which we'll see in a minute, there are a lot more 3 bedrooms than you would normally see in a typical garden style, 1990s project. But that's just because of the area that this is in. There's a high demand for that in this area. And as we went to the comps, we realized that there's a really high demand. In fact, there's a waiting list for 3-bedroom units in this market. There just aren't enough of them. And so we've got units that will be very easily convertible into 3-bedroom units. And that's part of the value add strategy actually that we have here, which I'll show you in a minute how easy that's going to be. But other revenue items like adding washer dryers, we've got some additional land where it will be easy to add some detached garages. Maybe we'll look at numbering spaces. There are some things that are not actually in our model at all that would actually potentially give us even more upside in additional revenue, such as reserved spaces, covered parking, things of that nature. So what we like to do though on things like that, and we did it on our asset in Texas that we acquired at the end of last year, is we did a survey of the residents. What kinds of things would you be interested in? And in the case of that deal, reserved parking was something that people were very interested in. And so we had it on our schedule to slurry and restripe the parking lot anyway. So we just told our contractor, you know what, while you're doing that, number all the spaces. You're painting stripes and you're painting curbs, just paint numbers on all the spaces. And so it didn't really cost that much more than what we were going to do anyway. And now we have numbered spaces. And in month 1, we had 105 units sign up for a $25 a month additional charge to have a reserved space. So it's those kinds of things that we love about multifamily. There are ideas like that when you spot them, they're relatively easy to do. So
105 units for an additional $25 a month. My goodness, think about what that does to our cash flow.
yeah, that's, I mean,
Yeah.
you throw a 4 cap or so on that, and you're almost $1 million of additional value created just from that one thing. So that's something we'll look at, but again, not in the numbers yet. There's quite a bit of a spread between where we are and where the comps are. We're actually newer than our two closest comps, but we're 1996, 97 vintage. Our two closest comps are in the mid 80s, 80, 85, and 87, I believe. But they've done a much better job of upgrading those. And so they've already tested the upgrade market for us, which is great. It's nice when you can see somebody else go first and achieve the rents that you're projecting so that you're not just, the first one blazing the trail, so to speak. So we'll show you that in a minute as well.
It was nice of them to test the market for us.
Exactly. So, management is always the key, right, to multifamily. So we've got a good local professional management company. They're called Volunteer Properties. They already work with some of our general partners on other assets that they own in Tennessee. I actually haven't worked with them yet. And so part of what I did when I was there, I stayed an extra day just on my own, and I kind of mystery shopped some of their assets in that market. Without even telling them, by the way, I didn't want them to prep anything. So I went around to several of their projects of all classes. But I found one in particular that's really similar to this asset, Avalon, similar vintage. It's kind of up a hill, similar to us. So it has a lot of that grade change and other drainage potential issues. I really wanted to see, how are they going to manage some of those kind of concerns? And I was very pleasantly surprised. It's very clean. It's very obvious that they're keeping good attention to detail. So we feel really good about the property management company that's going to be working with us. And again, they're local. They also actually expressed an interest in investing a couple $1 million in this alongside of us. So when you can have a management company that likes your deal enough, that they're going to not only work on it, but potentially put some of their own money into it as an investor, that's always exciting. So we're still talking to them about that. And they do invest in other projects with some of our partners. So anyway, it's always nice to have a good local operator that's there and that has a good experience. And then property improvements, already mentioned the capital budget. We'll get into more details on that in a minute. And then really just increasing the efficiency and the operations. There's a lot of what I'll call low-hanging fruit here as we go. Why don't we go to
you want to look at the units? Yes.
Here are the units. As you can see, very functional, very kind of clean, open, good floor plans. But it's just dated. It's got kind of the old appliances and the old countertops and the old cabinets. But there's nothing obsolete about any of this. So, you can see what we have planned here. Get rid of the carpet, go to that new, more modern, and actually easier to maintain and turn vinyl plank flooring. People like it. It looks like wood paneling or wood plank flooring, but it's really vinyl. And it's much easier when you do your unit turns than carpet. So we'll go to that, and we'll upgrade the kitchens, backsplash, appliances, all that kind of stuff. So, and there's really been nothing done yet. So a lot of good opportunity for us to take advantage of that.
I should say something here. For those who do not come from a real estate background, this is, again, another CEO level comment. One of the things that we look at when we decide what to do to the units to make them more modern is we look at what is in demand in the area. So Scott and several of our other general partners have gone out into the area, looked at other properties to see what's in demand. Is it carpeting? Is it the vinyl flooring? Is it stainless steel appliances versus black or white appliances, that type of thing? What are the trends? And it almost becomes a fashion decision. So we make a fashion decision that's driven by money. So anything that we upgrade, it's really driven by what is going to be attractive to future residents? What are they willing to pay for so that we can bump rents and deliver more profit to our investors?
And we always look at the return on investment on that incremental spend as well. Any incremental dollars we're going to spend on the CapEx, we want to see, a payback usually of 3 years max. So that's a 33% annual, ROI on those extra dollars that you're spending. And that's how we get the kinds of returns that we're getting is, we can do some of those things that don't cost very much necessarily, but have a real high ROI in those additional dollars. So yeah, let's keep moving through the slides
Yeah,
here.
sure.
Exterior upgrades. This is kind of exciting too. That's the leasing office that you see there behind the pool. Good traditional southeast, looking stuff, brick and paneling and all that. If you see on all the buildings though, that white trim, so the columns and the eaves and around the doors and windows and all of that needs to be just cleaned up and repainted. It was the white trim that was the most in need of some maintenance around the property. And again, that's relatively easy and low cost to do, and it just gives the whole property a pop when you do that. So, cleaning up some of that is going to be very important. I mentioned the high level of 3 bedrooms. That tells you that you've got more families with kids, and we certainly saw that at the comps as well as at this property. And so, one thing that is again real low hanging fruit and a place where the current management and ownership is kind of falling down on the job is they just don't give you that sense of safety, right? I mean, if you've got a family with kids and you see a gated community, you expect that gate to work, right? But it hasn't been working for about a year. And so, again, that's a real easy thing to just take over and really make a solid, good first impression when we take over that, okay, new ownership, new management, we fixed the gate. We're also going to add additional outdoor lighting. We're going to add security cameras around the property. And again, all of that to give that feeling of a safer community, safer environment. You'll see in a minute when we get to the aerial shot of the project that it already kind of sits up a hill. So you enter in one spot down below. And I love that for this kind of a project because that alone gives you a feeling of kind of, okay, I'm up and out of the way. I'm not just right there on the main drag. So I already have kind of a feeling of safety by being up the hill and off the main drag. But if my gate doesn't close and it's not well lit, and all of that doesn't make me feel very good as a resident potentially. And then the other thing is there used to be kind of a sorry, sad old playground set for kids, and it was getting out of out of repair, I guess you could say. And so the previous owner just removed it and didn't replace it with anything. And it was also in kind of a crummy location. So we're going to put that in it. We're going to find something that's much more colorful and modern and exciting. And we're going to put it where you can see it as a new resident when you first drive up to tour units, so that you can see right away, okay, hey, this is a kid-friendly place. It's somewhere that's nice and safe and all of that. So that's something we're going to add. The pool area is nice, but and it's very well landscaped and it's clean and all that, but it just needs a little pop. The furniture, maybe adding some outdoor kitchen features so people can do barbecue, that kind of stuff down there. So we'll be adding that. There's no package hub currently, so the office is basically receiving all kinds of packages, and that's an additional revenue item potentially if people have their own package hub spot near the mailboxes, and I'll show you where that's going to go in a minute. And then we already talked about some of the other things. One thing about the last bullet point there, landscaping and curb appeal. The landscaping is decent. It's not bad, but it could be better. And as we toured those 2 older 1980s vintage comps, one thing that really helped them stand out is that curb appeal when you drive up to them. They're very well and nicely landscaped and clean. And so that's another way that we can really add some good curb appeal and leasing appeal, I think, to this project.
Well, Scott, how much is all of this going to cost?
Whoa, what a nice segue, Ray. Good job. Yeah, so that 12,400 at the bottom actually should have been underneath just the interior up above. That's just what the budget is for the interiors. And actually the total, when you include all the exterior stuff, is closer to 20,000 a unit. If you just do the quick math, 2.85 divided by 145, it's almost 20,000 a unit total. But one thing we do like to look at is what am I spending on interior renovations? And it's typical to be in that kind of 8 to 10,000 range for a project like this one and of this vintage. So to have 12.4, really gives us some additional ability to step it up a notch and really compete with, class A minus, type projects. That's really where we want to be, in that B plus A minus range. And I like that because, another concern people have sometimes in markets like Nashville is, hey, if the market is this good, aren't people just going to build new units and take your tenants away and compete with you? Well, yes, they are building new units, but all those new units are in the luxury category that are much more expensive than we are currently, and much more expensive even than we're going to be after post renovation. So if you can be, nearly as nice, but at a significant discount to that newest brand new stuff, that's just the sweet spot. And that's where we intend to be. So that's why we've got a CapEx budget that's in this level, because we think it'll pay off real well.
Great. Let's talk about Nashville.
Yeah, this, for those who download the slides, this next slide is really a repeat of the one we hit at the front. So we can kind of skip over that one.
Okay.
Just go to, the next couple here are straight out of the broker's package. In all honesty, that's why the formatting is a little bit different. It's really just showing, who are some of the biggest employers, biggest job announcements. And then this slide here is talking about the airport and transportation things. One thing I'm not sure if I mentioned on the previous slide, the airport is actually getting a $1.2 billion upgrade project right now as well. So the city is actually spending quite a bit of money on infrastructure and things of that nature as well. So that's always good to see, a city that has enough to take care of all that stuff. So, all right, let's keep moving. I think we're going to get in the business plan in a bit here. Oh, actually, this is a really important slide to hit first. So our per unit price is 222, and that may seem high if you've looked at deals over the last several years. That's because we have a large average unit size, and it's also because it's Nashville. But one thing you have to compare that to is what's the median home price in the area, and as you can see, we're less than half of the median home price, and so that's always a good position to be in. The brand new luxury stuff that's going to be going in is in that 400 plus per unit range, and so the tenants that are in those you will lose to home buying sometimes. We won't have that scenario here. The renter market has increased a lot in Nashville. It used to be about a 55 to 56% of the residents owned their own home, and that number has been going down. It's in the 52% range now, and that's just a function of affordability and demographics and things of that nature. So the other thing, in fact, I think Byron is asking this question: the average current rent per unit and the projected rent per unit after renovations. So that's that third bubble on this slide, the 2181. So just under 2,200 is our targeted annual rent post renovation. And we'll show you on the unit mix slide in a little bit where we are currently, but that's where we'll be competing. And then the average household income is something you want to look at as well. So, 95,000 is certainly sufficient to support that kind of rent. No problem whatsoever there. This slide we always like to put in our presentations because it shows that we've got a good diverse job base. As I said before, jobs are the most important thing when you're looking at any real commercial real estate investment, but especially multifamily. Jobs really drives it. So you want to see that you're not just a one horse town, and obviously Nashville is a large diverse market. You can see a lot of different good categories here. Medical is always something you want to look for in apartments, technology, retail, financial services, things of that nature. These are good, stable, long-term employment industries. So they're not going anywhere, in other words. Good recession-resistant industries as well.
No one-horse town this is.
Yeah, no, Nashville's certainly not a one-horse.
Yeah.
It's a primary market these days. I will say, when I first started buying deals in Nashville, it was considered more of a secondary market, in the early 2000s. But now I would say it's definitely a very highly sought after core market in a lot of investors' mindsets. These are some of your top employers. The medical center obviously is big, but you've got a lot of good different industries here. Healthcare, industrial, manufacturing, government, of course. So a lot of different things here. Cracker Barrel. That always cracks me up because I didn't grow up with Cracker Barrel near me. So, but anytime I go across the country, and especially these road trips I've been on recently, to Atlanta, Nashville, and Birmingham, and it's like every exit and has at least a Cracker Barrel on it. It seems like. For those not familiar with Nashville, this is kind of a wide view map, just so you can see, how close in Avalon is. Close to the downtown, close to the airport. If you're familiar with the Grand Ole Opry, that's right there as well. That's a major touristy kind of thing. So all of that is in close striking distance. And then that big lake to the south, we'll show you in a minute on some of the overview photos. That's also a big recreational draw. So we're close to all that kind of good stuff. The newer product that's going in is either very urban. Actually, can you go back to the map?
Yes, sure.
The newer product is either very urban in kind of that midtown area just below the word Nashville. And so that's going to be a much different kind of renter than the suburban renter that we're looking at. But the other suburban growth kind of stuff is pretty far south. It's down in kind of Laverne, down 24, or down in kind of the Franklin area, down 65. And so those have a lot more traffic to deal with to get back into the employment. So we'd much rather buy a closer in asset like this and upgrade it, especially, if there's going to be some kind of recession or downturn. You'd rather be in a closer in location like that because people do always tend to kind of pull back to those closer locations and avoid the long drives and the traffic and all that. So that's another reason we like this location a lot. It's closer in, it's close to a lot of existing employment and amenities and things like that. All right, let's keep moving. Here's a good low aerial of the project. This is out of the broker's package. We normally would not highlight our own property in red. So just, if you're making your own presentation someday, I wouldn't usually choose red, but that's the property there in the bottom of the aerial. Just down the hill is a Kroger anchored shopping center with a lot of other good things in there as well, including an Outback Steakhouse and Petco and whatnot. In orange is a big medical center with a lot of jobs there. And then there's the lake in the far distance. You can see that the blue highlight area is kind of where you would go for the taking advantage of the lake. And then in the top right, that green highlighted area is the airport. So you're close to a lot of that good stuff right here. And as you can see, it's a nice established area. No weird stuff, going on. Moving to the next slide, just a couple different angles. We threw the Starbucks logo on there because we always like to see a Starbucks nearby. And one thing I should say, Ray mentioned I have a lot of background in other property types. Retail is particularly a property type that I've purchased, several $1 billion worth of all over the country. And retailers, particularly big brand name retailers like Kroger and Starbucks and some of the others that you see on here, Target, Home Depot, all of that. They have really good location scouts, and they know what their demographics are and what the buying power is in the area and all that kind of stuff. So if you can see good big brand names like that, and particularly even Starbucks, is a really good one to use for multifamily. There's a lot of crossover in things that you would look for locationally with multifamily if you can see those good big national brand names on the retailers around you. And so we've got plenty of that here. Moving to the next slide, just another angle to kind of show you a different direction. You can see the Walmart and Publix and a bunch of other brand names off, and all these are within a mile or two from the project. So we're in a good, well-established area. All right, moving on. Actually, stop on that monument sign for just a second. So here's a good picture, right? A picture's worth 1,000 words. One thing we said a lot about this project when we were doing our due diligence is that it has good bones. The project itself is well built and it's a good design. It's a timeless thing, so same thing, the monument sign here, it's positioned well, it's all brick, it's nice. But look at the actual name of the property itself in the middle. It's sort of faded and it's peeling off. And that's just so easy to take care of. And the existing owner and manager just hasn't done that. So, very low cost item to get a sign company in there and put a new sign on the middle. But we don't have to tear down the whole thing. We just need to clean it up and put a new thing on there and you're good to go. Maybe a little nicer landscaping, even with a little more color. So again, low hanging fruit kind of stuff that we can do that will really give this a new pop once we take it over. And that's one of them. Next slide kind of just gives you the overview. We've talked about many of these things already. Nothing really out of the ordinary here to talk about on any of this. The dog park and the fire pit area and the playground, things like that. Those are things we still need to add, and I'll show you on the aerial as we get to another slide here. This is it actually, yeah. So you can see it, the leasing center, the pool, the monument sign is all down there at the main entrance. That first set of trees, yeah, if you move your mouse kind of up and to the right a little bit there, that first set of trees, that's where the gate is. You can't really see it from this aerial, but just beyond the left-hand turn to go to the leasing office is where the gate is. And so the control panel is there, the gate is there, all the stuff is there. It's just the electronics that aren't working. And so we'll get that fixed right away. And then that little building just beyond the trees is the mail center, where all the mailboxes are. And so there's plenty of room to add a package hub there for Amazon, UPS, larger packages. Everybody's doing that these days, especially after 2020, right? There's so much of that. So we'll add that. And then the big grassy area just beyond that, there's a large flat grassy area right there that you can see when you first drive in. You can see it through the gate, even if the gate is closed. That's where we want to put a real nice, colorful, public school, quality or public park quality playground, set right there with some good colors and visual appeal to just draw your eye there. And then there's room for a dog park there as well. So when you have families, you need a place for the kids to play and for the dog to go run around and all that. And so there's plenty of room to do that. And we love that you can see it as a new potential renter when you're first driving in, if we put it there. The place where it used to be, I don't know if you remember, Ray, but if you want to point at that, it's up on the upper level to the left.
Okay.
Yeah, it's kind of the top rightmost part of that. So you can see in the middle of those units. Yeah, that's it right there. That's where that used to be. If you've got good eyes, you can see the old play set right there. So it's gone now. It's just a sand lot right there now. And we intend to add more garages there because that's another thing. There's a waiting list for garages at this property. So they don't have enough of them. You can see they do have, quite a few up there, but there's plenty of room for 2 more buildings on the left and 1 more building on the right where the old playset was. And that'll actually give us space for a maintenance shed as well for the maintenance guys up on the upper level. Because that's a pretty significant, hill to go up from the leasing center down below. So, we're going to get some golf carts. We're going to have a maintenance shed up there so that we've got better ability to handle all the work orders and take care of the residents better. Plus having additional garage spaces up there are certainly in demand right now. So that's part of what we have in mind.
We should mention they're using 1 or 2 garages right now as a maintenance shed. That's eating into revenue.
Right.
So that's one of the reasons we want to do a maintenance shed. Maintenance shed items should be in a maintenance shed, not in a garage that could produce revenue otherwise. Right. And we should also point out, as you mentioned before, none of the improvements that you mentioned are even considered as part of the potential revenue. So this is additional revenue that we're looking at.
Yeah, and there's actually a nice little turnout up there where that old playset is as well. So there's a place for a golf cart that a maintenance guy might be driving around. There's already a little turnout spot right there. So it sets up just perfectly to do that. And then there's room on the left-hand side where it's just green grass to add 2 more matching, garage buildings basically. Mm-hmm. And when you've got a waiting list, you don't want to be using garages for no revenue maintenance shed spaces. If anything, you want to add more. So that's certainly what we would look at doing. But yeah, that's a good overview. So here's the unit mix. The most common unit is that B1 in the middle. There's 104 of those, the 3-bedroom, 2-bath unit. And I want you to look at the square footage. It's 1,224 square feet, which is a good size unit. But look at the unit right above it. It's a 2-bedroom, 2-bath, and we have 21 of those, and it's the exact same square footage. And look at the rent differential between those two. It's $300. It's the same square footage. It's actually the same unit, which I'll show you in a second. And it just takes a couple of walls and you're done. So the 2-bedroom unit on the left you'll see there's kind of an open study where those kind of two walls just sort of end and then it stays open to the dining and living area. Look at how there's already a closet on the back wall in that study. To call something a bedroom, you need a door and a closet. So if you look over right next to it, the 3-bedroom unit, you'll see it's that exact same orientation to the living room and dining room. And all you got to do is extend those two walls, add the door, and you've already got your closet in there already. So it's a really low cost thing to convert those units and immediately pick up $300 of additional rent just on the existing, to say nothing of the other improvements we're going to do, which will allow us to drive those rents even more. So that particular floor plan, if you're paying close attention, you'll see it has a bigger master bedroom in the back. So the 3-bedroom that we're showing here is actually the larger square footage one, that's closer to the 4-bedroom square footage. And there aren't many 4-bedroom units. Actually, go back to the previous slide if you can.
The comps, yeah.
Okay. Yeah. So this is our unit mix. You can see those bigger units are 1486 each. So the 3-bedroom one, there aren't very many of those, and I don't think there's enough demand really to convert to 4 bedrooms, and the differential is not quite as big anyway. So, but really, 21 units, an extra 300 for a very small expense is a really good payback.
Yes.
So we're definitely going to do that. That was exciting to see that when we were out there doing our due diligence. And then the comps come up next. These are the 2-bedrooms. Let's actually look at the next slide, the 3-bedrooms, because that's more relevant. So South Point and Cherry Creek are both mid-80s projects, and the square footage is pretty similar. They're a little bit bigger on the 3-bedrooms, but they're already getting today 2250 and 2400 respectively. I went in both of those as a potential new renter. And they didn't have any availability as far out as their leasing report goes, which is 3 months. So they said they would take my name and put me in their database and send me an email if something's coming up, but they didn't have anything to show me and anything to even give me a quote on for a 3-bedroom unit. So there's a lot of demand for 3-bedrooms in the market. So both of those are very big projects too, as you can see. Cherry Creek, 627 units. It's huge. And actually, I must look like a pretty honest guy, because when I went into the leasing center, they said, give us your driver's license, and we'll just give you the key card and a set of keys to the model units, and you can just drive around the whole project and check it out yourself. So yeah, I took full advantage of that. I went everywhere and took pictures of
Data
it.
gathering.
So yeah, they were kind to let me do that. But it's a huge project. So it took a while to get all around it and see everything I wanted to. But both of those projects, as you can see, are very well occupied, and definitely make the case for the rent levels that we can hit in this market once we do our improvements. All right, moving on. Financials. Did you want to chime in on something, Ray? Sorry if I cut you.
No, that's fine. Let's go. Yeah, full steam.
All right. So the way that our financial model works is we gross up the top line item to those fully improved rents, but then we have to, obviously we're not going to do that day one when we first take it over. So we have to back that off with some significant economic vacancy. So the total vacancy loss of over $1 million year one is basically doing that. It's like a 26% economic vacancy loss over the new improved rents, because we won't have them all improved then. So it's going to take year 1 and 2, like I showed on the timeline before, to get through that. And then that's when, year 3, 4, 5, we'll be back down into that 9 to 10% total economic vacancy level at that point, based on the new rents. And then one other thing I'll just call out in case anybody's real sharp-eyed on the financials is the taxes are remaining flat for years 1, 2, and 3. So some people might ask, how come your taxes aren't increasing? That's because it was just reassessed. And so these are the new taxes, and they will stay flat like that for those first 3 years. That's really helpful when you're doing a value add project, because you don't have a big increase. They already got the big increase, in other words, and it will take them a few years before they'll reassess it again. So, you couple that with our interest-only financing, and that allows you to really do a lot in those first 3 years without negatively impacting your cash flow. So that's really the only stuff I wanted to call out on there. We're very conservative about that underwriting. A lot more detail there if you want to read about some of the assumptions that go into our underwriting. But a lot of capital budgeted to handle all the things that we need to do, and great returns on that. So, all right.
And this will all be part of the deck, so you can
if you want
go
to
through this
download
at will.
PDF of that, you certainly can. Couple last things. Frequently asked questions. Obviously, this is for accredited investors only. This is a 506c deal. The minimum is 100,000. You can invest with a self-directed IRA or 401k. We cannot. Sometimes people ask, and I didn't put it on here, but you cannot use 1031 money in a syndication like this. If you're familiar with the tax deferred exchange, the 1031, you would need to own directly the real estate, not shares in a syndication, to handle that. So, time horizon, we've completed our due diligence. Our initial close date is towards the end of September. We do have an extension if we need it. We'll only use that to take care of any loan issues that may come up. Sometimes, even with more, what would you call it? Even with more traditional, lenders like Freddie and Fannie, seems like you always get in the last week or two, an extra question or an extra thing they need or some kind of box they want to check off. So sometimes, that causes you to extend a little bit. So, but it is basically, first come, first serve in terms of the money getting in there. If you want to invest in this, and I'll let Ray address that. And then the profits and how that gets distributed. So there's a 7% preferred return. And what that means is all of the passive investors get all of the cash flow, 100% of it, until they get a cumulative 7% return. And then after that, if there's additional cash flow beyond that, then they would get a return of their capital. And once you've gotten all your initial capital back plus a 7% preferred return, then any additional profits would be split 50-50 between the sponsors and the limited partners or passive investors. So that's how that works. And, some people ask sometimes, hey, sometimes I see, a higher split. Sometimes it's 60-40 or 70-30 with some other deals. How come it's 50-50 here? Again, we're very conservative. That's why the fact that we can be showing these kinds of returns on this structure, those other syndicators that have to do that, it's because they basically need to be able to tweak the numbers to show a higher level of return to make the deal work and make it more appealing to people. But if you can get the same level of returns on this, and this is how we've always done it, and we're going to stick to that. So. That's about all I have to say on this. Did you have any other FAQs you wanted to address, Ray?
No, we're good. Due diligence is done as it says at the end, so that's pretty straightforward. Let's talk about the deal team.
Okie doke. Yeah, very experienced, obviously. The people that are involved here. I mean, I personally, I guess I didn't want to toot my horn too much here, but the 6 billion is me in my career. And no, that's not like a couple $1 billion portfolio deals or whatever. That's just a lot of onesie twosies. I think my average deal size is about 20 million in my career. So if you do enough of those, you eventually hit 6 billion. So that's me. Obviously, others that are involved with us on the general partner side also have experience too, including some partners that already have things actively right now in the Tennessee markets. So myself and Rod are partners in Cree Capital, and then Ray, obviously, there too. So good looking picture, Ray.
Hey, you too. Let's just pat each other on the back. Why don't we?
Yeah.
There we go. So we're coming towards the end. Again, this will all be part of the package. When you're ready to move forward, you can reach out to me and we can do a call, a Zoom call, phone call, what have you. Or if you're ready to go and review the documents, you can go to bridgetownpartners.com. We'll have that portal up and running 8 a.m. tomorrow morning, and you'll be able to get to the package there. And if you want to do a call or if you want to do a Zoom call, just reach out to me. You can do Calendly and we can get you on the calendar. We answered questions as we were going through, but if does anyone else on the call have questions that they'd like to share with us, you can put them in the Q&A section and we can address those. or you can reach out to me later and we can do those separately. We'll make sure that we're available to you. On questions. I think, Scott, you did a very thorough job of covering everything. And so what we'll do is I'll say going once, going twice. We'll end the official webinar, and that anyone who has questions, feel free to reach out to me. We'll make sure that we get you some answers there across the board. I know it's a lot to go through. You can review the recording, review the package, go through it in detail. We like to share as much information as possible so you can make the decision that works best for you.
All right.
Okay. Well, thank you so much, Scott. Thank you so much for joining us here. And for all of you who participated in the webinar, thank you for coming out this afternoon, this evening. And I look forward to speaking with you.
Thanks, Ray.
Thanks. Be well. Bye-bye.